Welcome. This is Chris. Here to report. It's March 14th, 2020. We've had a heck of a week in the market, so I'm going to talk a little bit about my personal experience surviving the week. And I have survived, as it turns out. I'm here. I may be a little broker on paper, but otherwise my health seems fine, even though Corona's out there. Got a wood stove fire going today. Got my cat, my dog. They seem to not even have a care in the world, which is usual. As long as they get their kibble, they're quite happy. So it's been a up and down, all over the place type of week for the markets. I'm not a trader. I'm not an active daily trader. I do have some. I'm invested in equities that are sitting in some retirement accounts. I'm fairly aggressively invested. I only invest in indexed funds so that I can kind of set it and forget it. But even within those index funds, they're market-based index funds, so they're tracking specific markets or specific sectors in the markets. And this week has clobbered everything. But I think I've seen my portfolio, which is all retirement account investments, take like everybody else, a 25 to 30% hit over the last week. I've watched my kids' IRA take a pummeling, which it's very small. She started at the peak, right? So we got her going this last fall. I had her jump into some ETFs that were riding very high. Now, I will say that during the week when the market was down, it hadn't hit bottom yet, but you didn't know what the bottom was. I did put a couple $1,000s into some ETFs. So my wife, I added an extra $1,000 into her just a straight up brokerage account and bought some ETFs. And I did the same thing for my kids' Roth IRA. I put an extra $1,000 in because I had it there just in cash. And said, now's a good time. And then, of course, the market proceeded to take another 10% drop the next day. So, I instantly did a head slap and said, well, I just lost $1,000. But as we've seen, the market bounced back up another 9% the following day. And it won't surprise me one bit to see the market continue with some volatility over the next month or so, right? In fact, that's how it works. The thing that I can say, I had moments myself towards the end of the week when you sensed that it was hitting a bottom where I thought, well, should I move money out of an emergency, my emergency fund? Because if I'm fortunate enough to have an emergency fund to fall back on if times get incredibly tough, but should I take some money out of that and put it into the market because I felt like the market was so low? And that conforms to those buy the dip type of ways of thinking that they obviously appeal to you. You always want to buy the dip. You want to buy when things are low. But I did have to fall back to a belief in my plan. And fundamentally, I have a plan. And my plan in the short term involves loading up my investment accounts and brokerage investments with a certain amount per year per a plan. But the biggest part of my plan for this year is to knock out, hopefully, the mortgage, right? And so every spare bit of cash that I have, I want to push at paying off my mortgage because I'm locked in. I'm not locked in. Actually, I have a variable rate mortgage that's based on a LIBOR, and rates are down. So my mortgage rate's down, but I'm paying about a little over 5% right now, which isn't killing me. But I look out 2 years, and if I didn't have to make payments that were incurring a 5% interest charge, that would be incredible. So I've decided this week not to deviate from the plan, not to try to pull in any other cash assets that I may have or deviate payments that are going against my mortgage, and just continue to put them at the house, right? Because that is a guaranteed, I'll be saving my future self 5%. Even if I could make, short term, I can see the market turn around. To me, that's too close to gambling, right? And I think when I fall back and listen to what some of the more intelligent who I consider wise investors are saying is to just stick to your long-term plan. So my long-term plan involves me having no mortgage payments when I'm retired, me having no debt when I'm retired, me having investments account that I can fall back on. But I'm not interested in beginning to treat those retirement investment accounts like they're short-term trading accounts, if that makes any sense at all. So I did have some, I won't say I was in a despair, but you definitely get into a funk when you know that, the $100 that you had yesterday is now worth $70, or, that never feels good. And so I definitely feel bad for folks. I feel particularly bad for folks that are either have just recently retired and are in the process of pulling assets out of things that might have been, incorrectly allocated, right? So if they didn't somehow transition into a cash posture where they had cash that wasn't subject to these market ups and downs, but they're trying to convert equities into usable cash right now, it's the worst time to do that. Or, for the investors that were either new to the game and they had a liquidity requirement that they didn't quite understand well enough, or hadn't planned for, and this is the first time that the market smacked them in the face, that hurts, right? And so hopefully it doesn't put them into a financial scenario where they're really strapped and having to borrow money to cover some shortfalls because they needed the liquidity that's just not there now. So my heart goes out to those people. But I would say, if you can, and if you've had those experiences, try to look for the lesson that's embedded in them. I know for my own self, these types of experiences just emphasize how important it is to have that type of bridge account for yourself as you enter those retirement years. You can't rely on assets that are in the equities market at the moment, or even within the 5 years leading up to your retirement. That this is the reason that you slowly start to reallocate your investments as you approach your retirement years, because you want to be more conservative, specifically with those assets that you need to use to live on. So yeah, this just reinforces that it pays to plan and it pays to stick to those types of plans. Now, as to what the future will bring, I would say stick with your plan. Who knows what the future will bring? Nobody knows. That's the whole point. You can't time the market, right? You think you can, but I'd say stick to your plan. If you're going to put some money in now per the plan, then put some money now in per the plan. I'll be doing so towards the end of the calendar year per my plan, and it wouldn't bother me at all if the market stayed low for the next 6 to 12 months, right? That wouldn't break my heart one tiny bit. But then again, that just, that plays to timing the market, and the market's going to do whatever it's going to do. I'll be putting money in more towards the end of the calendar year per my plan, and I think that will be just fine. And if I can continue to do that every year until I hit my retirement age, I think I'll be okay. Knowing that as I reach the end of my planning phase and I've hit that 5-year mark before I plan to retire, I do want to completely reevaluate the asset allocation and build up a bridge. Doesn't mean I have to pull everything out of my more aggressive, high-risk investments, but I definitely want to start moving some of those, selling while there's profits, moving them into either cash or low-risk types of bonds, CDs even, knowing that I'm going to be able to rely on those when I need them. So that's it. Been a rough week. Hang in there. It will be okay. Markets do tend to go up. I have no reason to believe this time will be much different than the other times. It has been a historic week, and it's been interesting to watch. So I'd say, keep your chin up if you can. Follow your plan, and you'll do all right. Thanks for watching. We'll see you next time.